Hi, this is Arvin Talley with Elixir Mortgage Lending. Today I wanted to speak about conventional, soft money, and hard money on a second loan. For those of you who are maybe looking into refinancing your home and have a very low interest rate you're trying to protect, if you have a good solid amount of equity, you can refinance and take money out as a second position loan. In conventional realm, we do a home equity line or a second loan. This is not a home equity line of credit. There is a difference. Just as a home equity line, which is really a freestanding second loan. And as far as second loans go, they do bear more risk for investors, which means you would have a higher interest rate. In general, it seems like the interest rates are on average about 1.5% to 2% higher than where the market is on a second. But in the case of conventional, you would qualify with needing income, higher credit scores, and that way you don't have to touch your first loan, especially if you got rates past the pandemic, somewhere between that 20, maybe 21, 2022, rates were incredible. And this way you can protect that first loan and still take money out if you need to pay off credit cards and things of that nature. And as a conventional loan, you can do a 30-year fixed term. So it breaks out the payments further out, keeps the payment lower. If you have credit cards you're trying to pay off, credit cards accrue interest daily. They are not amortized monthly like mortgages are, or calculated on an annual basis that way. So they are significantly different. And when I hear these rates of 22, 25, or 29% interest rate on a credit card, these are significantly more expensive than if you were to average the same length of time on a mortgage. The mortgage, the rate is lower, as well as the amortization is breaking up into monthly as opposed to daily. Now, if you don't have higher credit scores, to some degree, now we're talking about probably 640 and 680 minimum FICO score, but you have good cash flow, we can get into a section that I would call soft money. These are folks who are self-employed. Better than 680 is ideal. 640, the prospect is less, the equity position has to be stronger. But as far as if you have a 680 FICO score or above, the soft money option is a good option. They're generally a higher rate than where a conventional version of that would be. I would give you an estimate, the rate of being probably about 3 to 3.5% higher than where the market is on a first loan. So if, for example, the average, based on a 10-year is around 6.3, this is probably going to be in the high nines, my guess is. And they will allow you to do still a 30-year term or a longer term, and they're still fully amortized. Now, if you were looking to do a loan where your credit score is hurt, or you still have to have a ton of equity, but you need funds for whatever the reason is, and you don't want to touch the first, there are also hard money options. Hard money though, unfortunately, because of the current time and now the inventory out there is starting to grow, it's causing lenders to want to play it safer. And the loan to values are not as good. You're going to have a ton of equity to do that. Most cases on a hard money, between 50 to 60% loan to value is where you're going to get cut off. Some cases 65%. If it was previously we were able to go up to 70 or 75% loan to value, but those outcomes have changed. A lot of lenders, especially with lower FICO score, cut us off at 50% loan to value. So if you have for example, a home that you have a first on and you don't want to touch it, income is already tight coming in, but you have a ton of maybe debt that needs to get paid off, and it would still pay off the payment on this, but would clear that debt, perhaps help raise your credit. This hard money option could be sometimes an okay option. I'm not going to tell you it's a great option, and definitely when you hear the word hard money, you need to know this. The word hard money generally means it's a short-term loan. So it's going to come due sooner. In most cases, it's 1 to 3 years. I have seen them up to about 7 years term, but they are going to come due sooner. They're not 30-year fixed loans anymore. So it's an inferior option to the first two that I named off, but it is an option for those who don't have any other options. And as far as second loans go, since they do bear more risk as a hard money version, the rate on a hard money second is going to, in most cases, be double digits. I've seen them as probably 11.99 to even 16 or 17%. So these rates are going to be significantly higher than what it would be on a conventional loan or a conventional second or a soft money first or a second. So that is the position. In most cases, if you're doing a second loan, it has to be at bare minimum of $75,000 or more, and in most cases it'll be a minimum of $100,000. So let's say the property is worth $1 million. Well, on a $1 million property, the maximum we could probably finance on a lower FICO score is $500,000. So your existing loan cannot exist more than $400,000 if this loan takes place, because we have to fit the second loan, closing cost and everything else, the minimum amount of loan, depending on whether it's $75,000 or $100,000, plus the closing cost that has to get rolled in. So it can't exceed that. As far as second loan options, there are a little bit more. I'm just trying to make sure I hit these categories, but between conventional, soft money, and hard money, that is pretty much the gist of it. And as far as if you have any questions, feel free to reach out. I did skip one part, and that is on hard money. Most cases, our terms better serve people that is investment property for nationwide. In most cases in California is where we can do a hard money second. Hard money, not every state you can do a second position loan. In California, we can do it. In some cases, we can even do a primary residence on a hard money, but most cases is an investment when the word hard money comes in. With conventional loan, we can do it on a primary residence. And with soft money, most cases it's a primary residence. So the differentiation between conventional and soft money is still primary residence, but hard money, most cases, is investment property. If you have any questions, feel free to reach out to us. Thank you.